Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. Josh Knoll here. Got a very special returning guest host, John Luke Tyner, the head of fixed income at Aptus Capital Advisors. How you doing, man?
Yeah, thanks, Josh. Thanks for having me back on.
All right, very good. Well, we're excited to have you on. You got some feedback last time you were on the show, right?
Yeah.
You got some texts?
Yeah, some positive feedback.
Anybody ask for an autograph or anything that good?
Not that special.
All right, well, we are back again here in Coastal College's recording studio, beautiful downtown Fairhope, which consequently is just technically walking distance to your office and mine.
It's perfect.
Except when it's 100 degrees outside. We both drove, right?
Got a decent day today.
Right, yeah, better. We're ready to put on another great show for those of you tuning in. Listeners, John Luke and I are here to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we've got in store for you today. First segment, deep dive on our topic of the day. Second segment, roughly 30 minutes past the hour. That's headlines of the week. And then about 50 minutes-ish past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. I want y'all to buckle up. We've got a lot to get to. Quick background on me, for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call, 251-327-2124. Now, if you just missed that contact info, grab a pen and pad because we're going to repeat it several times throughout the show. I don't know if you heard the last episode, if you had a chance to listen to it, but in that episode, I asked the question, are investors I used you remember the Prince song?
Yeah.
Okay, you're old enough for that, right?
Yeah.
Okay. Party like it's 1999. So I asked, are investors partying like it's 1999 again? And what I mean by that is in 1999, can I ask, when did you graduate college?
2015.
2015. Goodness gracious, now I just feel ancient. Well, I graduated college in 1998. In 1999, of course, I didn't have any money in 1999, but the NASDAQ Composite Index was up over 85% that year.
Yeah.
Is that hilarious?
A couple great years, 97, 98,
Right.
and 99.
Yeah, the dot-com bubble. The other indexes, the major indexes, the S&P 500 gained 19.5% in 1999, and the Dow Jones was up 25%. And we just mentioned that was primarily due to the dot-com bubble and high investor demand for any company that had anything to do with the internet. You're too young to probably remember Pets.com, but that was kind of like the apex of the whole dot-com era. Before I got my questions for you, John Luke, let's do a quick comparison of 1999 to 2025. Because what I told listeners on the last episode is, you and I are going to talk about, is it like 1999? Are we in a bubble? And then more importantly, if we are, does it matter? So we're going to circle back to that. But for 2025 year to date, at the end of August 2025, the S&P 500's year-to-date return is approximately 10.61%. Does that sound about right?
Yep.
Okay. The NASDAQ Composite year-to-date is around 11.43, and the Dow Jones is around 6.41. Now, of course, all those numbers are solid, but it's significantly below the 1999 gains. So even though they're not as high, have you heard the argument? Let's start with this. Have you heard the argument that there's a bubble? Do your bear side people, there's bears and there's bulls. Do your bear side people think that there's a bubble?
If you follow any social media, there is always someone claiming that there's bubbles. And there probably is in different asset classes at all times. It just doesn't affect the general investor.
Right. Well, so I would say and we mentioned bears and bulls. So a bear market person has a negative outlook on the overall stock market performance, right? Yep. A bull market or a someone with a bull market outlook thinks that the market's going to continue with strong gains. The bear side of the argument is that person is going to say that artificial intelligence has pushed certain tech stocks to overvaluation, particularly the Magnificent Seven. Now, regular listeners already know these, but let's list them for some of you new listeners. The Magnificent Seven refer to Alphabet, which is Google, Amazon, Apple, Meta, Microsoft, NVIDIA, and Meta is Facebook, and then Tesla, which I've made the argument before. I don't think Tesla belongs in that group, but that's a conversation for another day. The bull side argument would be the fact that we seem to be experiencing a broad-based bull market run. And I don't know if you saw the little number I pulled. The S&P 500, if you pull obviously all the Magnificent Seven are in that index. So if you pull those out, and now you got the quote-unquote S&P 493, the 493 performance, the S&P 493 performance, anything other than the Magnificent Seven, is still over 5.5%. So it's doing okay. But that leads me to two questions that we're going to get into the meat of this. So here we go, John Luke. You ready for this? One, are we in a stock market bubble? And two, if we are in a bubble, does it matter? So I posed that statement on last week's episode. Even if we are in a bubble, I'm not sure it matters anymore. In the short run, I could hear the gasps through the radio. I could hear people saying this guy's lost his marbles. But if you look at all the stock market bubbles since 2008, none of them have been very long-lived. With that said, as I told listeners last week, I did not want them to chisel my hot take into stone just yet. I needed to get an industry expert's opinion first, which I consider you. So what do you think on those things? Are we in a bubble? And if so, does it matter?
Yeah, so the last couple of years, 2022, the market returns have been very friendly, right? We had last year, the market was up 25%. The year before, it was up just shy of 30%. And obviously, since the lows in COVID, markets have moved drastically higher. Now, there's a lot of things supporting that, but I think one of the most important, when you really look at the fundamentals of companies, are they growing earnings? And what you're seeing is these beast companies, the Mag 7, as we all call them, are growing earnings at incredible levels. And so if you compare that back to the dot-com period where anyone and everyone was just putting .com into their stock ticker and trying to IPO it at whatever valuation that they could, they weren't backed by sustainable fundamentals. And so I think the argument for the Mag 7 today is these are unbelievably well-run companies that have incredible amount of innovation and growth, and they're actually bringing good stuff to our lives. You know, put aside social media and some of that stuff. The innovation and the technology is creating advancements in productivity. It's making us more connected, which obviously there's bad parts of all of it.
Sure.
But for the better part, like, 50 years ago to make an international call, 20 years ago to make an international call was a few dollars a minute. Now you can FaceTime anyone, anywhere in the world. And so I think there's a lot of merit behind the companies that are driving markets higher. It is nice to see more of a broad-based participation from small caps and the average stock, kind of looking at like an equal weight index instead of the market cap weighted index. But to answer the question more simply, I just don't see that those names are in a bubble because they are actually growing and they're cash flow machines. And so when cash flows are backing valuations, you've got the ability to have some support, right? It's not based on thin air.
Well, all right, so let's talk about that. For the listeners, explain what you mean by that these companies actually have earnings, particularly when you're contrasting it to the world of the late 90s, even though I know you weren't in the market then. But
I've read a lot about it.
You've read it, yeah. I mean, I'm sure it was a case study even through college.
Yep.
To compare that to the earnings or lack thereof any earnings with some of those .com companies, why is this so different from that time period?
Yeah, so back then, the bulk of the companies were issuing equities, issuing equity by IPOing their stocks, right? And so they were getting cash to spend on all of the infrastructure built out, like the broadband and all of the cable and things to that extent, which obviously long-term had huge benefits to us as a population. But they weren't funded on actual profits from these companies. Whereas today, when NVIDIA makes chips, they've got massive gross margins on the production of their product. I think it's like 84%. And so when you look at, they turn $1 of sales revenue into 84 cents of gross earnings. And so the ability for them to actually, be profitable and take those profits and invest it into this AI CapEx boom that we're seeing, at some point, markets will require a return on these investments that they're making. But at this point, they're financing it the right way.
Right. Well, in one of those right ways, for if anyone, I don't know, what did you study in college? Let's start with that.
Accounting and finance.
Okay, all right. That's my oldest son, Peyton, is an accounting and finance double major at Auburn right now. So great, 2 majors there. So you looked at market history then, some.
Oh, yeah.
Because if you look at the run-up, so let's set the stage just a little bit. You and I are sitting here not knowing if Microsoft or NVIDIA or Tesla or any of them are overvalued or undervalued, right? Because you have to, one, you'd have to have a crystal ball, and 2, you just need to have this thing play out. But what we do know is the manner in which they're building out the infrastructure significantly differs than the lead up to past bubbles.
Correct.
Let's go. We mentioned the dot-com bubble. Let's talk about 2008. 2008, I was in real estate. It was the time of, I can just tell you from experience, if I wanted a loan, all I had to do was walk in the bank and sign something.
The ninjas.
It was crazy. You're right. Yeah, with that, no income,
no job.
No, yeah. Here's a loan.
Yeah.
And I even had a job, so I made it even more dangerous. I had a development company, but it was fueled by these lack of. Yes, there were things getting built, but they were getting way over capacity on money that was borrowed.
Yep.
If you go even further back in time, and I talked about this on the last episode, but I'm a late 1800s, early 1900s U.S. American history nerd. Don't know why, I just am. But if you look at what fueled the railroad expansion during that time period, was all borrowed money.
Debt.
It was crazy.
Yep.
In fact, the railroad barons rarely had hardly any of their own money in that whole deal. And even when those railroad companies would crash, they walked away. It was unbelievable. It's kind of similar to what some private equity companies will do when they come in and they buy a company and they basically load it up with debt, pull all the cash out, and then the company eventually can't service its own debt.
Yep.
Yeah, they learned that from the railroad barons. So what you're telling us and what I agree with is while we can't say that things aren't overvalued right now, we don't know that. The one thing we can say is this run-up is not being fueled by massive amounts of debt. Agreed?
Yep.
Right.
And what is equity? When you think about it from that perspective, you're taking an ownership in the future cash flows of that company. If you're buying the stock, you at some point expect, some type of return. And so the benefit of financing these with cash flow instead of with debt is that there isn't that debt burden that overhangs many of these past bubbles that have occurred. Now, again, at some point, the market participants like us are going to require to see a return on all of this AI CapEx spend that we're seeing, right? Like at some point, that the companies have to show a return. Now, at this point, the market is just rewarding the spend because they think that at some point the AI is going to be, lucratively profitable.
Right. All right. So we're answering that question. The short answer is whether we don't know 100% if there's a bubble or not. That's a dangerous game to play. But what we do know is some of the fundamentals of what's going on right now in the market valuation run-up differ significantly, fundamentally from 1999, 2008. We're in agreement there.
And multiples are expensive, but nowhere near levels that they were in the dot-com period. And earnings growth also is leaps and bounds better than it was in those past times.
All right, so then let's pivot to the thornier question. Let's say that we're wrong and we are in a bubble. Does it matter? Do bubbles matter anymore? Now, I'm not. This is not a got you question.
Yeah.
I genuinely want to know your opinion on this because it was something that honestly occurred to me from all the research I've been doing the last couple of weeks for the show. I'm looking at these bubbles and all this fear mongering, and then I'm looking. Obviously, I've got the hindsight of 20. I've got 2020 hindsight view on what has happened, but you can point to pretty much any time period outside of 2008 was a little prolonged. But if investors had just hung on, they'd have been fine.
Yep.
So question is, let's assume we are in a bubble. Does it matter?
Well, I think that's why you have a well-diversified portfolio. You don't just own U.S. large-cap stocks. You own small caps. You own international markets, emerging markets, and other defensive mechanisms in the portfolio. And then the second answer is if we are in a bubble and markets re-rate lower, Well, there are ways that you can take advantage of it, and that's a key piece of what we do at Aptus and our investment philosophy.
Which we're going to talk about in the headlines. You saw
Exactly.
that. Yeah. So, and I think the answer to the bubble question is going to transition us to the last part here of segment 1. So, John Luke, I made a statement on last week's episode. I want to see if you agree with it, because I'll say things that come out of my mouth and they sound a little crazy, and I always wonder what you and JD think. But this is what I said. This isn't that crazy. I told listeners that the overall stock market performance is more closely tied to money supply and monetary policy than most people realize. Agreed?
Agree.
Strong
100%.
agree?
Yes.
Okay. My argument is that our federal government has ran federal budget deficits consistently over the past 6 decades. You know it went that far back?
Yep. It's
Yeah.
like 7-8% a year.
Yeah. Basically when we came off the gold standard.
Yes.
Right? Which we kind of had to do, so that it's not banging that time period, 1971. But there is just, the fact of the matter, there is just way more money in our system versus, I don't know if you saw this, but in 1980, the M2 money supply. Do you deal with M2, M1, all that?
Oh, yeah.
Do a better job of M2 than I did last week, because I'm like, it's just the money in the system.
Yeah, I mean, that's kind of the simple way to think about it. The problem is that the target moves with how they report on it.
Correct.
So it's cash, it's deposits in the bank, it's CDs. It's basically the national savings.
Okay, yeah, money market funds,
Yeah.
stuff like that. So when I give you these numbers, listeners, understand there's a reason we say approximately. But in January of 1980, the money supply was approximately 1.5 trillion. In 1999, January 1999, it was 4.4 trillion. Do you know what it is? Well, you know what it is. January 2025, the M2 money supply is 22.1 trillion. That is a 20-fold increase over 1980 and a 4 times last week, 5 times increase from 1999. My argument is that money is like water and it wants to go somewhere. And I would also argue, and I'm going to turn it over to you, that I think you can directly correlate the increase in money supply to the dramatic increase in the major stock market indexes over the last 50 to 60 years. What do you think?
Yeah, I think it's accurate. Money's going to look for a productive home that can keep up with the debasement. And the other side of that money supply increase is just the cost in living, right, to
Yes.
everyone. And so as the money supply increases and there's not supply to kind of fill up for it in terms of goods and services, then costs go up.
Well, and as the last episode you and I did was about the erosion of purchasing power,
Yep,
right?
yep.
These are interesting numbers. We gave the money supply numbers. Let's do these. On 1979, December 31st, the NASDAQ composite closed at 151. Let's just call it 151. As of this recording, it is 21,005. It's over 21,500. In December 31st, 1979, the S&P 500 closed at 108. I'm rounding. As this recording, it's over 6,500. Now that gives you an idea. The NASDAQ and the S&P were fairly close in valuations in 1979, and now the NASDAQ is over 3 times the valuation of the S&P. That's interesting, right? That shows you the power of tech,
Yeah,
right?
and declining interest rates
And
since
decline.
that period.
That's fantastic. And then the Dow Jones, December 31st, 1979, was at 839. Again, I'm rounding. It's well over 45,000 now. What do you when you hear those numbers? What do you think when somebody is so fearful of the long-term market and putting their money? I want to be safe, John Luke.
Yeah.
What comes to mind when you hear that?
Well, there's
Based on those numbers I just told you.
There's a stupid saying that says bears sound smart, bulls make money. And so I think
I love that.
That sums it up pretty well. I think you have a great article coming up in segment 2 about just holding on for, market volatility. It's kind of the toll of capturing those long-term returns.
Bears sound smart, bulls make money. Oh, I'm stealing that. That's great. You said that's an old saying?
Yeah, that's not mine.
Oh, that's a good one.
It's a good one to copy, though.
All right. Well, as you alluded to, we've got a lot of great headlines to get to in the second segment. I hope you all stick around for that. If you've liked what you've heard so far and you'd like to set up a follow-up conversation with us, it's very easy to do. You can just give us a call, old-fashioned phone call. It doesn't cost you $200 for international, like John Luke said earlier. It's all local. John Luke, I grew up in such the country, man, and I'm old enough. you're going to, I'm going on a side note here, listeners. So we had to do, did you ever see the black phones with the rotary dial?
Oh, yeah.
Did you know that people didn't own those?
No.
Did you know you rented those from Bell or AT, whatever it was?
So the subscription model's been around for a long time?
Yes. So those things that would hang on the wall, the phone, and you had to do the rotary dial, which God help us if we had to dial somebody that way now. We'd never get through. But those were not owned. You rented those from the phone company. And even where I was from in the country, we didn't have to start using area code on anything. I mean, for years. I mean, if you called somebody, it was, dun, 222 or what, 755, da, 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 da. We didn't even, I'm not even sure I even knew the area code growing up because there was only like 2,000 people in the whole county. So anyway, I digress. You all can call us 251-327-2124, or you can go to the website GulfCoastFA.com. The FA stands for Financial Advisor.com. On the site, there is a blue button in the upper right-hand corner. Click that. That will put a meeting on my calendar. You have three choices. You can do a 15-minute introductory phone call. You can do a 30-minute Zoom. Or my preference, schedule an in-person meeting in any of our three office locations. That's downtown Fairhope, or in Orange Beach. We're just down the road from the wharf off Canal. Or in Mobile off Dauphin Street, near the intersection of Dauphin Street and I-65. However you reach out to us, make sure you do it. We'd love to meet with you. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we're going to give you our honest opinion about these headlines. So join us after the break to hear me and John Luke Tyner discuss this week's relevant headlines in our Headlines of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Knoll, here alongside guest co-host John Luke Tyner of Aptus Capital Advisors. So as we discussed before the break, every week we scour the World Wide Web, as Michelle calls it, for financial articles that pertain to those of you in or near retirement. Our job is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our reference articles yourself, we include the links in our show transcript, which you can find on our website, GulfCoastFA.com. Just go into the podcast tab. We put it up after this show airs on the radio. We put up a recording and transcript. Now, without further ado, here's Headlines of the Week. So, John, I'm going to read it, and then we're going to get your reaction, okay?
Cool.
Now, there was a little bit of heavy lifting in the first segment, so I thought I'd give you a layup to start this headline section. And for those, you've got a handful of people that listen to this show that know you, but for those that don't, Aptus Capital Advisors has an abnormal amount of basketball players in its workforce.
And I don't meet the criteria.
And I shouldn't, but I played anyway. So I thought I'd give you in honor of basketball. I thought, and very good players, by the way, I'd give you a layup. I picked a recent article that you wrote. It's actually found on the Aptus Capital Advisors blog page, which you guys do a fantastic job with. It is simply titled Opportunity in Municipal Bonds, ? So we spent the majority of our show opening discussing equities and the NASDAQ and the S&P and the Dow Jones and equity measures. But I think it's important to discuss municipal bonds because as you state in your article, quote, historically, municipal bonds have shown better after-tax returns for high tax bracket investors. So if you don't mind, would you briefly describe municipal bonds, what's been going on with them and their recent performance, and why this matters to investors, particularly you high-income investors that are tuning in?
Yeah, so municipal bonds are an interesting asset class within the investment universe. They're bonds, but they typically have superior tax benefits for high net worth investors. And so a municipal bond is simply a state or local government that's issuing debt for a project. Think like a school or maybe a utility and sewer line for a city like here in Fairhope. And so there's bond issuances that fund these projects. The benefit to investors for investing in their local community is that they typically avoid federal and often state taxes. And so for states where tax rates are high, they can be a very beneficial way to lower your taxable income and to get some tax-free income into your portfolio.
Now, historically, municipal bonds were considered a relatively safe investment for the most part.
They're very safe if you look at defaults of
Right.
municipal bonds relative to corporate bonds. And of course, there's a spectrum of there's high yield bonds. So
Right.
maybe they finance a highway or a toll road or a stadium or things like that where the actual municipality can't tax revenue to pay off the bond. So
Understood.
a lot of times, like with the revenue bond, our utilities that we pay every month to Fairhope goes to supporting the infrastructure and the bond payments of the interest, right? Or a school bond is backed typically by the ad valorem taxes of the municipality. And so if the school gets in a bind, they can call us and say, hey, sorry, your tax rate's going up 1% in order to service the debt. So there are some backfalls that make these investments more safe. And then, the beauty of the U.S. is that you've got this state right mixed in with the federal government.
Right.
And so the states have the ability to manage their finances. They're typically much smaller. You put it on the scale of a city, it's even smaller. And they typically don't do like our government, where we're $37 trillion in debt.
Good one, good dig. So bondholders in 2022 had quite a ride. So can you explain, we actually back then we had a client come in, had a really, really heavy municipal bond portfolio that was tied to the fact that they were really high income and that was the only place they could get tax-free income, right?
Yep.
But their bond portfolio looked terrible. So what happened then, and do we have any inklings of some of that coming on with some of these rates going down again?
Right. So you're not bypassing interest rate risk when you invest in any bonds, unless it's like an overnight, right? So there's interest rate risk associated with municipal bonds, just like there are taxable bonds. And so if rates went from 5% to 10%, then the price of your bond is going lower because the market rate is much higher at current levels versus where you bought those. So when you buy the bonds, any type of bond, it matters in terms of what the return is. If rates move, it's going to fluctuate the price value of that security. The benefit that I was trying to highlight in the municipal space in this article is obviously interest rates now are much higher than they were in 2022.
Right.
Right, and before. They were very low. And so a lot of municipal issuers took advantage of that, right? They borrowed money when rates were dirt cheap, and they spent it on good stuff for the community. At the impact for the investor. The benefit from here is that a lot of municipalities' financials are in really good shape.
Okay.
If you look at after COVID, many of these local governments got a lot of money in stimulus after the COVID stimulus packages that were in place. And so one of the things that impacted municipal bond returns the last couple of years is there wasn't a lot of supply because they didn't have to borrow.
That's a great point.
And so now what you're seeing is as some of that money's rolling off, there's more issuance. And so more issuance has led to the spreads widening and making them, I think, in my opinion, more relatively attractive than they have been. And there's a couple of other impasses, like banks are typically big buyers of municipal bonds. Well, the lower that the tax rate is for the bank, the less benefit they get to owning it. And so you've had, number one, as interest rates have come up, the cash flow profile of banks has decreased. And so they've had less cash to invest in bonds in general, right? Mm-hmm. Banks, their goal is to take your deposits and make a loan, but they can't do that with all of the money. They have to buy other bonds, other safe investments like municipal bonds, treasury bonds, etc. And so the backdrop from here is that you've got relatively high levels of nominal rates, nominal yields on these municipal bonds. But then when you tack on top of that, 36, 40, 45% tax rates, you're talking about 6 to 7% tax equivalent yields.
Okay.
And so that's just something we haven't seen in a long time. And that gives you some good defensibility even if rates move.
I like it. Very good. All right. So before we go to our next article, I got a couple questions for you. And we didn't rehearse this ahead of time, so I'm not 100% sure how you're going to answer. As the head of fixed income for Aptos Capital Advisors, your day in and day out job is dealing with bonds,
Yep.
right? Like we just talked about there. You have a deep understanding of the bond market, as listeners just heard. Now, I know you don't deal with the insurance side of our business as much as I do anyway, but you're at least familiar with fixed index annuities.
Yep.
Right? Okay. So when I tell you that there's producers in my line of work that tell clients that fixed index annuities are a good quote unquote bond alternative, what's your reaction to that? I'm not trying to set you up.
It depends.
Okay. Because I don't like that statement, but I'd like to hear your response.
Well, I think it's all about the financial plan. Everyone's financial plan is unique, and the liquidity needs are different for everyone. The thing that I hate about annuities is that they're typically high fees and they're illiquid. And so when anything kind of meets that criteria, and even if the client says, hey, I don't need this money for 5 years, I promise I won't need it. In 2 years, they find this house that's, down in Gulf Shores, and they want to buy it and they want the money and they can't get it. And so the lack of liquidity for any investment is always a red flag to me.
All right. Well, then that sets the table for our next article. It's from Forbes, and it's titled 3 Reasons Fixed Index Annuities Are Better Than Bonds in Your Retirement Portfolio. The article claims that fixed index annuities, which I'm going to say FIAs, that's the industry term for them. The article claims that FIAs are better because they have a higher earning potential, full principal protection, and my favorite, lower costs, including the claim that FIAs offer no fee, quote unquote, no fee options, which is such an artful BS twist on how our industry works. It kind of made me chuckle. When I tell you that with your deep understanding of bonds, and I have a pretty deep understanding of fixed index annuities, if I was sitting across there and you and I were having an argument like we're in Goodwill Hunting, and we're talking about these things, and I said, my FIA has higher earning potential, full principal protection, and sometimes it doesn't cost the client a dime. What's your rebuttal to my Goodwill Hunting argument here?
My first boss, as I was coming out of school and I worked on a trading floor where we traded bonds, and he would come around constantly and say, this ain't no charity. And so the first really bone to pick is on that third point, that there's no cost.
Right.
That's ridiculous.
Right. Yeah. The claim will be the insurance company pays them directly, and that's, the folks, I'm not holier than thou here. I came up on the insurance side. I've received more than my fair share of commissions. And the truth of the matter is the insurance company does pay the commission. But I can promise you that the higher the commission, the more handcuffs and limitations and things that you're going to and you're going to have around your premium, your investment you put into the annuity contract.
It comes out of the outcome for the client.
100%. Every time.
Simply as that.
Right. And it really, not to get on too much of a tangent, but it really chaps my behind that they will use some producers will use the increase in income rider. I'm getting a Nerdville here on you. But most fixed index annuities will offer an income rider. And on that income rider, they'll have some type of automatic increase per year, usually between 4 and 8%. They'll say, every year that you don't trigger this income rider, we'll give you another 6% of the income output, right? They will take those words and use it as, we guarantee you an 8% return on your fixed index annuity. And as I banged my head against the wall, because I have people come in and swear, their guy told them, I get guaranteed 8%, man. You're not going to beat that. And I have to tell them, it's not guaranteed 8% on your money. That's compound growth. This is guaranteed 8% of returning your money to you, right? Now, if you end up living a long time and you go well past the premium that you paid into the FIA fixed index annuity originally, then you made out. The insurance company made a bad bet. But either way, the main thing we want to do, especially with the show that we do, we just want people to be with eyes wide open when they get into these things because they have a place, right?
Yeah, and anything that says no downside potential is probably going to have some caveats, right?
Correct.
What as you pointed out, some examples of this in past conversations is if the market's up 25% like it was last year, and you're leaving a huge chunk of that on the table in this illiquid structure, there's a cost to that, right? There's an opportunity cost. And so there's always an opportunity cost to something like this. And then if it's based on any type of market return into the future, well, what happens if we have a 3 or 4 stretch where markets don't go up?
Right.
And you just get back your principal.
That's all you get. You get zero. Which means your real return is?
Your real return is getting smoked.
Right. Very good. All right, our third article, let's pivot. Morningstar. Is that did you read them?
Yeah.
Trusted site, right?
We use some of their analytics.
Well, as regular listeners know, I try to avoid sites with paywalls because the people that go to our blog or where we carry the show transcript, the last thing I want them doing is clicking on an article link and it wants them to subscribe, right? So Morningstar is a great free source of what I think is usually pretty relevant information. They've got a recent article titled, "What We've Learned from 150 Years of Stock Market Crashes." So the article states that it took the U.S. stock market 18 months to recover from its most recent bear market, the downturn in December 2021. I don't remember it being that long. Does that sound right?
Yeah, I'm not.
It's what it says.
Sure.
I mean, it seemed like a well-researched article. I don't remember it being that long. What I remember is the previous downturn, which is in March 2020, when COVID popped on the scene. That only took, this one I believe, it only took investors 4 months to recoup their losses.
Yep.
And in some of our clients' case, we saw it happen even faster than that. It was the craziest thing we'd ever seen.
Yep.
This article also has a fun graph showing the value of $1 invested in the stock market in 1870 and how that $1 now would be worth over $32,000. That's hilarious. The author claims that history tells us, the main thing that history tells us about navigating volatile markets, fancy way of saying markets going up and down, is that they're worth navigating. Do you agree?
Yeah, absolutely. I mean, the first stats that you laid out on returns since 1979 on the NASDAQ, the S&P, the Dow, it pays to be bullish long term.
Yeah, I had now you would have had to know when to sell, right? But if you had put $1 million into the market at the beginning of 1999, and done nothing more than did the NASDAQ composite, you would have had $1,850,000. Now, that's probably a terrible example because that means you both were great at timing the market, both getting in and getting out, right? But if you extrapolate that out, here's the thing that probably aggravates me the most. I understand when people are fearful of the market crashing. And sometimes I probably, I think you maybe fall in this camp. I know JD does, where we can come across as a little aggressive on the stock market investing. But I can tell you, I was a home builder and developer in 2008. Man, I know exactly what it feels like when the market crashes. Yeah. I mean, to the 10th degree.
Yep.
So when someone is fearful about the market crashing and wiping out their portfolio, I don't discount that. I don't try to beat them over the head and say, well, that's just because you don't understand the stock market, blah, 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 blah. That's not my heartburn. My heartburn is the producers and quote unquote or advisors in our industry that use that very fear to keep people from investing at least part of their portfolio into the only thing that's been proven over the last 100 years that can at least stay with or beat inflation, and that is the stock market.
Stocks.
Right.
Arguably the best wealth generator for the average man ever, at least U.S. stocks.
Right. And so that's really my aggravation there is for a part of your portfolio that is long-term. And what most people are kind of coming to terms with now that come in and want, they're retiring in their 60s and they're seeing their mom and dad live into their 90s. They're kind of coming to terms with, hey, this money better last a while.
Yeah.
Right?
Yeah. And that's a huge point of our investment philosophy at Aptus and how we build portfolios is that the required rate of return is probably higher than you think because people are living much longer. The cost of living is increasing at a higher rate than what the government tells us it is. And so it's a big piece to be able to invest in things that can really grow and keep up.
Well, you all, and maybe this is JD coin term, but as we pivot to our last article, JD has a saying on your investment philosophy, which we're going to talk about. He calls it own the risk, but
hedge the tails.
Hedge the tails. All right. So last article of the day. It's something we discussed before on the show. I thought it'd be good to refresh listeners' memories. The article is from Investopedia, yet another good site. It's called Beginner's Guide to Hedging, Definition and Example of Hedges in Finance. This article details the basic of using derivatives to protect downside risk on an investor's portfolio. I don't want to get too far into the weeds on this, John Luke, because we're doing okay on time. But could you give a high-level explanation? You've teased it a couple times earlier in the show, but how Aptus uses hedges when managing investments and why you all think it's a good strategy. You said own the risk and hedge the tail.
tails.
What's that mean?
Yeah. So our philosophy is we want to own as much risk asset as we can. So just think S&P 500, just stocks in general. And we want to hedge the bad outcome. So the last 100 years, only about 6% of that time, the market's been down 20% or more.
That's right.
Now, there's been a couple of nasty ones in there. And if you think about, how returns kind of play out, so think about like a bell curve, and sorry for being a little bit on the stat side.
That's okay. Hey, I'm an economist at heart too.
The right tail of markets are when markets are really friendly. So think like 15% and higher.
Right.
So since 1950, 27% of years, the market has been up 20% or greater.
So 2024 would have been a right tail event.
23, 24,
Right.
2020. Yeah. So
yes. Okay.
over time, you get more right tail moves in markets. And probably your money supply comment has a little to do with that.
Yes.
But risk assets tend to go up, and they go up a lot more aggressively than what most people realize. The left tail is the nasty returns. That's your dot-com bubble, your financial crisis, the period of COVID, although, as you pointed out, snapped back pretty quickly, very quickly. So that's the ugly returns. And then the middle is the average market return, which is 8 or 9%, but it's only happened 4 times over the last 100 years where the market's been at the average, right? It rarely happens.
It rarely happens.
And
That's
so
hilarious.
Thinking about building investments or building portfolios that can adapt and perform in those environments, I want to get a bigger piece of those right tail environments, right? I want to participate as much as possible. So that goes to the mantra of more stocks in a portfolio, less bonds, bigger engine for the portfolio to grow. The left tail environment is where the hedges come in. And a hedge is simply insurance against the downside in stocks. So if I own $100 of stocks and I own a dollar of insurance against the stock portfolio. So I guess the better way to put it would be if I have $100, I can put $99 in stocks, $1 in insurance.
Right.
Well, that $1 of insurance is negatively correlated to the market. That just means it goes the opposite direction. If the market goes down, the insurance, my hedge, goes up in value. And so the benefit of that is you've got diversification, you've got correlation benefits. And so the goal of a hedge is to protect on the downside, to allow you to take more risk, aka hedging those tails. Mm-hmm. The other key benefit of having a hedge, especially how we define it, where it's actively managed, because markets are so fast, you want to be able to take advantage of that protection. When your insurance policy pays out, I want to put those profits in my pocket to then redeploy back into more stocks. And so, as Warren Buffett says, you want to buy when there's blood in the streets. Mm-hmm. If you don't have cash, you can't reinvest. But if you have profits from hedges, it gives you the opportunity to buy stocks when everyone's running. And so a key piece of having hedged equity or having hedges in your portfolio is to give you a correlation benefit, but also to give you the 1-2 punch, protect your butt on the way down, but create capital to reinvest back when the outlook for future returns is much greater.
I like it. That's very good. Yeah, you said 6% of the time of the stock market has been negative 20%.
Or
right?
greater.
Or greater. And I would say 100% of the time, any crap that you see on talking heads on TV are saying that the market's going to crash.
Yeah, I mean,
it never stops.
The last 5 years has been a great illustration.
Yes.
Kind of another stat for you. So historically, the market sees a 20% drawdown every 5.4 years.
Right.
Right? How many have we seen this decade already?
Right.
3.
Yes.
Right? 2020, 2022, and then earlier this year.
Yep.
So even though returns, as you pointed out, this year have been friendly, it's been a bumpy ride. Thanks, Mr. Trump.
Yes.
But I think the backdrop on that is markets are volatile, but volatility can be your friend if you're well prepared.
I like it, and that's where the hedges come in. Very good. All right, listeners, if you've liked what you've heard and you want to continue the conversation about your own personal retirement dreams and goals, give us a call, 251-327-2124, or visit the website, Gulf Coast FAs and financialadvisor.com. Blue button, upper right-hand corner. That'll put either a 15-minute phone call on my calendar or 30-minute Zoom, or my preference, let's just meet in person. Downtown Fairhope, Orange Beach, or Mobile. However you reach out to us, make sure you do. Put something on the calendar. We'd love to meet with you. All right, folks, coming up next, we got Joshua's Crystal Ball and Big Mouth. Would have been some of my predictions. Actually, John Luke, we're running short on time, so I'm going to tee you up to explain something I think is really important that's happening in our industry, and then give your opinion. Are mutual funds dead? Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here. So, John Luke, you're opinionated. You have opinions. I have opinions.
Yep.
I'd say if we were on this radio show with no opinions, it'd be pretty dull, all right?
Yep.
So, I like making predictions. I feel like I'm kind of skeptical of my own business, which is funny. Probably why the radio shows work so well. So I tend to be kind of right because there's just a lot of nonsense that goes on in the industry. You all are the same way. You kind of cut through and clarify. But let's get at this, Joshua's Crystal Ball and Big Mouth. So this is going to be your crystal ball and Big Mouth. I'm going to tee it up, and I got to be quick here. The modern mutual fund was created in 1924, and the first U.S.-based exchange-traded fund, or ETF for short, not arriving until nearly 70 years later in 1993 when I was graduating high school. Woohoo. As of April 2025, the combined assets of mutual funds in the U.S. is somewhere around $28 trillion. Got that? $28 trillion. ETF assets in July 2025 are somewhere around $12 trillion. All right, so 28 and 12. Everybody got that number? That sound about right?
Yep.
However, ETFs surpassed $1 trillion in inflows, new assets in 2024. By contrast, mutual funds had an outflow. They lost assets of almost $400 billion in 2024, and this trend is continuing. We don't have time for all the nitty-gritty, but here's what I want to ask. Can you help listeners understand the basic difference between ETFs and mutual funds, why Aptus uses ETFs instead of mutual funds, and then quickly as we close the show, I want to get a prediction. Will ETFs continue this acceleration of their total dominance of mutual funds? Are mutual funds obsolete?
Yeah, it's a great point, and we're huge proponents of ETFs at Aptus. We've been one of the first, if not the first, active options-based ETF issuer, not only in Alabama, but in the whole country.
Agreed, yep.
And so our business is really bet on the ETF structure and the favorability of it moving forward, and that growth, I think, really illustrates what we're seeing across the industry. And so the nitty-gritty of the ETF and mutual fund difference is ETFs work very similarly. It's a pooled vehicle of assets. What you can own inside of the ETF is, of course, limited by the SEC and the regulatory body, so it's nothing crazy.
Right.
But the key difference is the ETFs trade throughout the day, so they're more liquid. Mutual funds just trade one time per day. They strike the NAV, the net asset value of the fund at the end of the day, and they transact there. So just say, for a silly example, if the market was down 10% intraday, which we've seen some of those,
yes,
and you put a buy order in on a mutual fund, and the market goes from minus 10 at 9 a.m.
It rallies in the afternoon.
It closes
right
flat at the day, and you put an order in at 9 a.m. when you thought the market was lower.
You missed.
You're not getting filled until the end of the day.
That's right.
So really, that's a huge knock. Whereas with an ETF, it's traded actively throughout the day. You can buy and sell at 8:30 a.m. from 8:30 a.m. Central Time till 3 p.m. Central Time, as many times as you want. So that's a benefit. The other benefit is the taxation. ETFs, for I guess, better in terms of just regulatory policy. And, how all of those things work is a political machine that I don't have too much sense on. But basically, they've given us a gift of massive tax benefits to own ETFs. And basically, the issuers of ETFs have the ability to avoid selling securities and realizing gains in a lot of cases, and instead they can redeem out the securities basically for cash.
Right.
And so what that does is it keeps you from washing away, it washes away a number of the tax ramifications. The other really big downside of mutual funds is basically you're just a percent owner of that fund, and whatever goes on at the macro level of that fund, then there's a consequence for you. So what you see with mutual funds a lot is capital gains distributions.
That's right.
And a lot of times they come at the worst time, right? If you think about 2022, for an example, a lot of investors sold their holdings in mutual funds, which gave which made the fund managers sell the securities at the market.
At the wrong time.
And a lot of times they were selling positions that were at large gains.
Right.
Well, then those get passed through pro rata based on your ownership to the owners of the fund. And so the downside of that is you can get a tax bill when you didn't do anything. You just held the fund.
Right. Very good. That's right. Well, let me jump in. Is it going to keep going this way?
I think that the trend is definitely the friend
Yeah,
to ETFs.
I think the momentum's there.
When it gets on a level playing field, I don't know, maybe 5 or 10 more years, where it may not even take that long, where it's equal.
I think we've scratched a thing there. We need to have a conversation, flesh this out a little more, because I wasn't expecting that much detail. That's great, because you all have, as we're closing here, you all have a blog that talks about the tax efficiency of ETFs on Aptus Capital Advisors.
Yeah, check that out. The other big thing, I guess the benefit for the mutual fund business is every retirement plan basically is locked into a menu of investments. And for the most part, their 401ks are limited to buying mutual funds. And so as that changes, I think that could progress this even faster.
100%. All right. Well, listeners, that is our show for the week. I want to give a huge thank you to my guest co-host, Jean-Luc Tyner. Are you glad you came on again?
Yeah.
You always crush it, man. Thank you to our show sponsor, that's Providence Partners and Mr. J. Stubbs. Thank you to our awesome radio station, that is FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music, that's local band Sloth Racer. Huge thank you to the show producer, that's my son Peyton Knoll. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Till we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.